Okay, this is the profile of Estate Surveyor and Valuer, Dr. Timothy Tunde Oladokun. Estate Surveyor and Valuer Timothy Tunde Oladokun is an associate professor at the Department of Estate Management, Obafemi Awolowo University, Ile-Ife, Nigeria. He holds an MSc degree in Estate Management from University of Lagos. He also holds the Master of Science degree and PhD by research of the Obafemi Awolowo University in Ile-Ife, Nigeria. His research interests is in the area of corporate real estate management, facilities management, and real estate education. Prior to joining the academia, Estate Surveyor and Valuer Oladokun had over 12 years experience in active professional practice. He is an associate member of Nigerian Institution of Estate Surveyors and Valuers and registered with Estate Surveyors and Valuers Registration Board of Nigeria. He won the Emerald Group Publishing UK Property Management Best Paper Award in 2010. He is the current head, Department of Estate Management, Obafemi Awolowo University, Ile-Ife, Nigeria. At the professional level, Estate Surveyor and Valuer Oladokun was the public relations officer of Osun State Branch of the Nigerian Institution of Estate Surveyors and Valuers. He was a member of the Corporate Affairs Committee of the Nigerian Institution of Estate Surveyors and Valuers. He is a member of the Board of Examiners of the Nigerian Institution of Estate Surveyors and Valuers and a reviewer to many local and international reputable journals. He is also a member of the Implementation Committee for the establishment of the Nigerian College of Estate Management of Nigerian Institution of Estate Surveyors and Valuers. As a teacher, Estate Surveyor and Valuer Oladokun teaches courses in estate management, touching different branches of estate management. He was the managing editor, Journal of Property Research and Construction, and an editor, Environmental Design and Management International Conference Proceedings, and served as Secretary, International Conference Organizing Committee on Responsive Built Environment. He has supervised many MSc and PhD theses and has published widely in both local and international reputable journals. Distinguished colleagues in the noble profession, join me to welcome Estate Surveyor and Valuer Timothy Tunde Oladokun, who is going to do justice to the topic of this morning's webinar. Thank you. Welcome, sir. Hello? Hello?
Yes, sir. He's not on now. Maybe he's trying to reconnect back, sir. I think maybe it's from his end, sir.
Okay. Okay. Yeah. No problem. Why he tries to join? Now let me quickly go through this webinar series. Okay. I think because of where I am now, I may not be able to know the topic of the previous series. But let me just say that this webinar started sometimes in March last year, if I'm correct, March last year or March in 2021. When I enter the office now, I'm going to share the screen later of to be able to show. Okay, I think Dr. Oladokun, okay, still trying to connect. Okay, yes, he's back. Yeah, are you back now, sir? Hello, sir. Can you hear me?
Yeah, we are now together. Good morning.
All right. Good morning, sir. Welcome,
yes, sir.
Yes, sir.
And let me salute the organizers, Mr. Kamaruddin Lawal. I salute the MD of Reals Academy for a job well done and for all the good things that you have done. I appreciate you for the opportunity, at least to be part of this webinar series. So I also want to salute and I appreciate all our very senior colleagues. I appreciate our wonderful and loving sponsors. I'm aware the first vice president of our local institution is around, and so many other wonderful people that are here with us. I salute every one of us anyway. As I've been said, I am Timothy Tunde Oladokun. Well, I'm one of your colleagues in the profession, so we have been here together for some times. The only thing I just want to say like that is the fact that, well, in my department now, I handed over as the HOD now, so we have a HOD, substantive HOD now, in person of Professor M.O. Oyewole. I have served, headships is a terminal period, and that's why it has expired, so now I have a HOD. So I just want to place that one on record. So having said that, so I want to appreciate everybody for this opportunity. The topic before me that we are sharing together is titled Structuring Assumptions, Evaluation Report for Proper Interpretation of Opinion of Value. So structuring that. So I'm trying to share the string. The end result of whatever we do as estate surveyors and valuers is contained in our opinion of value. And the extent to which it is properly worded and structured largely depends on how well clients will understand what we are doing. Permit me to say that any report that is presented that is not understood will communicate no meaning to the recipient. And if you all agree that the essence of valuation report, valuation itself is a tool that is used for decision making, then it is so important that it is well communicated and it is well presented in a manner and mode that decision taking will be effective, it will be accurate, and it will be proper. And that's why we must understand. It has been said, I don't want to go and be defining what valuation is all about. I'm sure we all understand what valuation means. But largely, we all need to understand the fact that valuation has always been said that it is an art as well as a science. And be that as it is, a lot of us still operate and we are still at that level of operating the art aspect of. Why is it an art? It's an art because it largely requires practical applications. Whatever we have learned in the university, you go out and implement it. Of course, in a number of assignments, it requires that experience will come to bear for proper implementation right away from the time of inspections to the time of preparation of reports. So it is also so important because it is creative. It requires some creativity. And in order to be creative, you see, it is not all these ones that are learned in the university. And of course, it goes beyond what you have learned in the university. The error is just now to think that what you have learned in the university is of no relevance, because it is also a science, and it follows divine principles, methods, and ways of breathing. And those concepts and principles are systematic. They must be systematically followed, so that at the end of the day, whatever is produced become acceptable and become something that could not be faulted. So that's why we need to look at that. And it's also a science because more often than not, you observe, it follows some principles. It follows some researches need to be done, analysis and implementations. And in doing all these ones, so you will all agree with me, the fact that a lot of things have to be done. And valuation hangs largely on a number of things. The purpose of valuation is so important. The method of valuation is so important. Data is so important. And the assumptions made. And that is why in the assumptions that are made, it must be logical and appropriate. So, and that is why I am going through this training or these discussions, going through some of these points together so that we can understand that those legs, none of the legs should be faulty, because a faulty legs will bring down the whole house. It's just like a pillar. So once the pillar or the column is not standing well, then there will be a problem. So I am taking us through this one to really look at valuation in the valuation. So that's the outline, is just to look at it that, well, in the introduction, I just want to briefly look at why. Because valuation in the global setting must be in tandem with global practice. It must be in tandem with acceptable norms and standards. Because all over the world, it has been discovered that there's a big mistake. The challenge ahead of us as service provider in the valuation industry is bridging that mismatch, because it has been established that there's a mismatch between service delivery and service satisfactions. And this one has given us a lot of problems. Clients no longer trusting our opinion of value, inaccuracies, and a lot of valuations have been largely established, not only in Nigeria, but all over the world. And as it is, well, the surface is that valuers should be able to earn income. But when you look at it, it is the fact that a dissatisfied client will not pay. And that is why valuation cannot continue to be the way we have been perceiving it or have been seeing it. Also, it must also be established that clients and equally of valuation are now sophisticated. Most of them understand what they want. Most of them already understand some of the methods, at least to an extent. Most of them are even going for some other trainings as far as valuation is concerned to really get themselves wrong, because it is a decision tool which either man or make their own products. And that is why valuation is just not being done for the sake of its own per se, because it is a tool that is used for some other things. So it becomes important for us to get it right from the beginning, to get all the legs of valuation right. So, and that requires that as providers, so we have to provide great service, satisfying service. We have to be able to meet the needs of our clients. And because of these sophistications that has also kept into real estate industry, we have to be able to provide services in special ways, different ways that cannot be faulted by anybody. That is, it is in ways that anybody will be able to agree that, okay, look, the principles are okay, whatever we have done is okay. And that is why we need to understand all this one. So there is the need for us to have a paradigm shift to ensuring that services value are added to our services. So that one is so important. Please, we need to get it right. Now, the second thing, so from here, I now go to the next slide, please. Now, valuation procedure. Of course, many of us, we are used to this, so it's not a new thing. A number of us have been involved in a number of valuation assignments that are in addition to getting valuation instructions, getting the brief. So the next thing is to make an inquiry and get all our data or instructions perfected. Then we proceed to ensure that all stakeholders, clients, and everybody that needs to be there are carried out. We make inquiry and we collate and review all data and information that will be required. Remember, I said that valuation hangs on 4 main things. What's the purpose, the data requirements, we carry out analysis, the method that are adopted, as well as the assumptions that are made. And those assumptions drive a lot of things. And that's why we will try to look at some of these ones. So in addition to getting financial data and information where it is required, more often than not in a number of issues, it requires historical financial statements to be with us. Then the evaluator goes ahead to obtain and conduct research. So on relevant economic, industry, and market data, appropriate approaches of value are adopted. And these are main three methods: the market approach, the income approach, and cost approach. So we will quickly look at all those ones to really see to what extent they can do that. So those are the procedures before we now make the analysis and get it done. So I want now to quickly look at the various approaches, because assumptions are made right away from in respect of all aspects of and activities that has to do with the valuation assignments. But importantly, there are approaches that have been tested. Like I said, that as a science, the methods or approaches are adopted and they are now analyzed. So we need to understand, or maybe perhaps just to be refreshing our brain or our minds on these three acceptable methods of contemporary methods, because there are other methods of valuations, but those ones that we are used to are the contemporary ones. The contemporary ones are good, but they all have their own weaknesses as much as they have their own advantages. But it just needs to be understood that accurate appraisal depends on the method that is adopted. But once the appropriate method is adopted, then the assumptions behind all these behind each of the approaches must be well understood and must be well captured and restructured. So it is only then that it will be able to communicate meanings to the client. Then you also need to know that valuation clients are of different categories. While we deal with individuals as clients, we deal with governments, we deal with financial institutions, and that is why the understanding of the various needs or requirements are so important. You need to understand what, because before you now choose the appropriate method, we must understand what is the purpose. That is, what does the client want? And understanding of what the client wants will let us know that, okay, look, this is the value concept in terms of the value basis, the basis of value that we use, and the appropriate method. So in understanding these ones, there are three methods of valuations that are so important. There's the market approach, so then the cost approach, and the income approach. So I just want us to quickly look at, so let's go to the next distance and see. Which one is the market comparisons? This is a method or an approach of an estimate of value, which combines or compares a subject property with recently sold properties called comparables. So we need to look at that. What we do is a method of value. We use it on a daily basis, but what we are emphasizing today is that the use must be well assumed. It must be properly, it must stand on the proper pedestal so that we will not be doing something that is wrong. Of course, it is a known fact that no two properties are identical. And that is why in using comparable methods, comparable here is so important. Getting a comparable, that is an identical property, and which is not adjusted, because the two of them might not perfectly be the same. So we have to make adjustment for differences and similarities in the comparables. In the next distance, we'll be looking at how to choose the comparable. But whatever comparable that is chosen must be based on the property rights. The sale conditions must be the same. The physical features and the sales date, most of these ones must be very close to each other. So what we are saying is that comparable that will be used, because this is based on comparing the property at hand with the one that has recently been sold. But even though we are making comparisons, then the properties must be very subject to each other. They must be similar. They must have been sold within the last a period that is not too far away from each other. And they must have been sold within the same condition that are there. So I made mention of comparables because that's what we are looking at. So how do we look at comparables? Because we have to be careful that sales price are made to account for the similar features. Please go to the next. Yes, you are right. So you make adjustment and make sure to account for the similar features. Where the number of toilets are different, so adjustments need to be made. Where other things are different, so I will not be able to go into much details. But the age and conditions of the buildings have to be examined, and they should not be too far away from each other. The date of sales, what are the terms of sales, so that we will be sure that the sales was not under duress, or the property was not sold between relatives, or it was not by special purchasers, and it was not sold at a discounted price. That's why that one is so important. Then the location must be very, very similar. It will not be too far away from each other, so that, because as we know that a major factor determining the value of property is location. So the location should not be too far away from each other. Relatively, they must be equal. Then the features need to be there in terms of what is the lot size, landscaping, the types and quality of constructions, number in terms of rooms, square feet, and living and hardwood. So all this one has to be examined. So these ones are the ones that will help in the choice of comparables. Let's go to the next slide. So the other approach is the cost approach. This is an approach which uses cost. The valuer uses this one for special purpose. I will later explain the assumption or the logic behind each of these approaches, but I'm only just trying to remind us or refreshing our minds of this one that we have already known before. Uses either the replacement cost approach or the reproduction cost approach to ensure that we arrive at an acceptable opinion of value. So, and in doing this one, 5 good methods are adopted. Number one, the value of the land is known. Then we get the current cost of construction. I said, well, we can always the reproduction cost. When it's reproduction, we are looking at the fact that a replica of the building using materials, construction, and method and design of the original building as at the time it was constructed. But when you are now saying you are replacing, the difference is that as at this time, though you are using the cost, but you are mindful of having construction method, current ones, contemporary methods, so that you have a building that can still give the same utility. So once you are now able to get that one, then the next thing is, because the new one might be of higher value than the old one. The old one could have suffered depreciation or loss in value. So, and that's what is referred to as depreciation. So allowance is made for that. And that one, whatever allowance which is referred to as a depreciation is now taken away from the cost, from the current construction cost. And as a result of that, so whatever we arrive at, so is added to the land value. So to get so the market value. So for that one. So let's move to the next slide. So in doing depreciation, I have said that cost is so important. There are some elements of cost that you need to look at. There are so many ways by which you get the cost. It might have to be that we look at the square foot method, where the cost per square foot of the recently built comparable is multiplied. So by the number of the square feet in the subject property, then it could be by the use of the unit in place method, or you use the quantity survey method, which estimates the quantities of raw material. That is, you make use of the raw materials. So that will be needed to replace. So these are the various ways by which you get the building cost. I'm trying to, because I have said that you have to get your cost of construction now. How much will it cost you to either replace or reproduce the building. So, and in doing that, these are the various methods by which one can get to that. And the depreciation, which is the loss in value, is just talking about the negativity. So that must have resulted in the value of, or in the value of the improvement over times. And this could be either physical deteriorations, and this can be in terms of, well, the painting, the roof replacement, needs replacement. Some of them are no longer working well, or there are deteriorations or structural problems. So these ones have to be taken cognizance of. Then functional obsolescence. The fact that a property is newly built today does not mean it cannot suffer obsolescence. So the designs could have been faulty. There could be design failure. There could be faulty designs and some of these other ones. Or that the appliances are already outdated and they are no longer in demand, or they are no longer in vogue. So some of the features that are no longer there, making the building not to be functionally acceptable, especially in terms of demand. So allowance has to be made for this. Then economic obsolescence. This one has to do with external factors to the properties. This one has to do with maybe pollutions, changes in the economy of the country, and some other things. So that will have bearing on these ones. So we make depreciations before one arrives at appropriate depreciations on the cost constructions, and before one now goes into getting the depreciated replacement cost, so which is now added to the land value to get at that one. So let's make progress. Then the last approach is the income approach. And this one is just, it talks of the relationship between the rate of return that an investor requires and the net income. Every property produces income. In fact, this one is used mostly for income producing properties. As long as it generates income, or as long as it is possible for you to estimate that, oh, this is the income that you can, so the surrogate income that you can get from that. So this is used for it, income generating. So you use it for all those forms of building, office apartments, office buildings, commercial buildings, and the likes. And how is this one done? The important thing is to get the gross income. So, and that's based on market rates. So it might not be as a result of in-place revenue. What this one means is it might not be as a result of, it might not be based on the rent passing, but what is supposed to be the full rental passing. What is the full rental income in respect of the building? Because the rent passing or the contract rent might not be the full rental value. And it could be as a result of some factors I have made mention of. Perhaps the transaction was as a result of, was subject to maybe some relationship issues, or it could have been as a result of special purchasers, or because some concessions have been made, or because the agreement has been consolidated long time ago and the rent has not been subject to review. So, but important thing is that you get the gross rent, and that is just by understanding or obtaining the gross income. If you remember, I said, because income or the data is so important, you have to get the accurate data. Then frequencies and other potential losses. We'll still be talking about this one when we are talking about are deducted from that. Then to arrive at the net operating income. So once you get the net of operating income, the net thing is what should be the rate of return. This one is always obtained by the value, and that's why we said making your assumptions in getting your you have to, it must be reasonable, it must be appropriate, because the rate of return is, as we do it, get it by saying, okay, what is the net income divided by your capital value, and you arrive at the capitalization rate. And this one is from comparables, because you can always use, once it is market derived, then it could not be faulted, then it will work. So we look at these ones and now capitalize whatever income that is there. So that gives us the value on basis of the income approach. This one could be done in 2 ways. So let's proceed to the next slide. Wow. Please move forward. Hello. Hello.
Sir, the admin is working on it, sir.
Okay, okay. Or if there's a problem, I can share it from here. Can I share it from here?
Yes, sir, you can share it from there.
Okay, but I need to be given the permission to do that. Okay, the next one. Sorry, I think everybody can hear my voice from here. Now, in income approach, we can make use of the direct capitalization. You know, the capitalization is to capitalize income using appropriate rate of interest. And I have explained that we get that one by, from comparables, of course, you can just find the net income divided by the capital value, so to give an appropriate rate of income. So with that one, so we can capitalize. But in doing these ones, it could be done directly because, like I have said, it's a function of the clients that we are discussing with. Are you discussing with individuals, banks, and other? Because some of the assignments goes beyond you just put or place value on something. Before you, a lot of analysis are informed, and that's why it's a science. And that's why we should turn our belief from just thinking that, oh, the theories we learn to the universities are no longer relevant. That is not true. Because whatever is being done, the principles are still the same, and they have been tested. The concepts are worldwide and globally accepted. So there are things that we must get to do. So in doing these ones, I have said that we look at the gross income divide whatever, I mean, we net off. So whatever the vacancy and be able to come up. So at the end of the day, to get the operating income. As once we get the operating income, which is the net income, so then this one is capitalized using the appropriate capital rate. So we need to understand that. So, but there another way of doing this capitalization is what is referred to as the gross income multipliers. And we use it to, you see, look, the first one is because you use it because you can get income directly from these ones. But there are some properties that you might not be able to, they are not on themselves producing income. But you can pulverize that, you can pulverize that or deduce rents from them using comparables. So as a result of that, you can get or deduce income or arrive at that. So through other properties, either that have been purchased or that are recently let. So you use it for quite a lot of things. For instance, for these ones, you always look at it. When you are using this method, if for residential properties, you always make use of gross monthly income. But for commercial and industrial properties, you can use the gross annual income to get these ones. And how do you get your multiplier, the gross income multiplier? It's always the sales price by the rental income. If you remember the other one, I told you that the multiplier, you get it by rental income divided by your sales price. This one will give you the sales price divided by your rental income. And whatever you operate from that, so you will be able to get it. And once you have your rental income, you multiply it by GIM and you get the value. So like I have said, that assumption is, so those are the three commonly adopted methods of valuation. Some people will tell you there are 5 methods of valuations. But however, I think it's just a matter of nomenclature. It is believed that some of those other methods are incorporated or they are part or variants of some of these ones. Like if you argue now that, okay, look, there's profit method of valuation conventionally. Yes, it is. But it is believed that it is still a variant of the income because you still come and so arrive at the income which is now eventually capitalized. So that is why the important thing is understanding the fact that these 3 conventional methods are very, very important. I know we have always been making assumptions because the bulk of our contention this morning is to look at assumptions. There are standard valuation assumptions that we make. When you look at it, in many of our valuation reports, you see that people have valuation assumptions that say, okay, look, that the various information with which we have been supplied are true, that the owner's claim to title is true and good, marketable, and free from any legal or other statutory rights that can affect the property and its value, that the property is not adversely affected by or subject to revocation, right of occupancy, severance, road widening, new rules proposal, and some other one. Then we go ahead and say, okay, look, in our valuation assumptions, that the property is free from onerous charges and restrictions, that the property has planning permissions, that no harmful or hazardous material has been used. These are okay, they are accepted assumptions. But the question is, to what extent are they proven? To what extent do we go ahead to ensure that these are really assumptions that can stand the test of time? So this one will now take us to look at there are logic behind any of the methods you are adopting. There's always a logic behind them. For instance, because assumptions you are making must be logical, it must be appropriate, and it must be able to stand the test of time. It must, in fact, it must be able to carry you through. Behind the cost approach, see, when you are adopting, because I know many valuers do that in practice, we just use the cost approach. And whether knowingly or unknowingly, we just say, because a property has been sold, or okay, I get the cost, which is okay. But we must understand that behind the cost approach, there's something that drives it. The logic behind cost approach is that it follows the principles of substitution. You have something, it is being substituted. And every valuer must look at it that a prudent buyer will not pay more than an item. He will not pay for it than the cost of acquiring a substitute new item with the same utility as the subject asset. Let me explain. I have a block of 4 flats, and I have put a value of 20 million naira on it. Maybe in Fan, Ikorodu, or anywhere. But the valuer must look at it that once you are doing these ones, so the buyer has an option. He can go and buy land, rebuild it, and have something like that. And of course, a rational buyer will not pay for more than it will cost him to get a new one, get land, rebuild it in a new way, and reproduce another one. So if it will cost somebody to do all those ones at the rate of 15 million naira, and your value is 20 million naira, it means something is wrong. Because in valuation, what you are doing is interpreting the behavior of buyers and sellers. That when this thing is put in the open market or in the market, so to say, how will buyers behave? What would they do? And that is why every valuer must look at the fact that when you want to adopt this cost approach method, you must understand that the cover that your clients, anybody who would come and place money on it, has options. So you will also now have to be guided by that principles of substitution, that no one will pay for how much it will cost him to reproduce, to substitute that in a similar environment to get something that will give him something of equal utility, like what you want or what you are offering him. So that must drive you when you are making this, look at that. So, and that's what will now help you in terms of whatever data you are getting, the analysis you are doing, and other things. Then behind the market approach is the sales comparison approach. It also had a logic. And the logic is that a prudent purchaser will only pay not more than for an item than how much it will cost him to acquire an existing replacement in the market. For God's sake, if he can just go to somewhere and buy it, so if he will get it lower than what you are doing it, then he will not buy it. So you must also now be guided by that these rational buyers. So, and that's why I made mention of the fact that they are now sophisticated. Clients already understand what they are doing. They have options, and they know that once this one is not okay, we can go somewhere now, even though given the same market conditions and market factors. So how would they behave? So what they will behave is that a prudent purchaser will not want to pay for anything, will not pay more than what you will get if you want to go and acquire an existing one and somewhere else, different from what you have. So once you have that in mind, it will help you. Then the third approach is that, which is the income approach, that a rational purchaser will likely base his buying decisions upon potential future income. And that's why I said the income approach, wherever you use, whether you use any other one, throughput method, whether you use the profit method or this other one, in income approach, the concern of a buyer, of a valuer, is to get the income. But this income, later we'll be looking at those various assumptions, whether it is sustainable, to what extent can you sustain them? So can anything happen that will affect all those ones? But importantly, you must know when you are adopting this one that the logic is that a rational purchaser bases his decision on the fact that what will be the potential future income generated or by the fact that he's the owner of these properties. So we need to look at that one. So it means in practice, we need to understand, and that is why it might not just be too appropriate for you just to limit yourself to just one method of valuations. In getting this thing done, using a combination of 2-3 methods will really help to give the best in whatever one is doing. And that's why we must now go beyond, okay, I have just placed a value because somebody has given me cost. I have just gone because the property has been sold like this, which is to get the price of the property. And that's why it is always argued that price is not value. And at the same time, cost, which is a measure of past sacrifice, is not also tantamount to value. So in valuations, a number of things must have to bear, and the assumptions are what we are doing. But I went to those methods of valuation because it guide whatever you are doing, so that when you are doing this, you must know the assumptions you are making, that there are logical assumptions you are making in respect of this one. I have said that we have a lot of those ones, but we need to work because all these assumptions and they determine to what extent our valuation is. Some of them eventually serve as limiting conditions. And that is why in the report, you must know that your report is what speaks for you. And that's why valuation reports must be detailed enough. It must be well worded. It must be well structured to communicate the intention. As valuers, you are not supposed to keep some things in mind, which is not part of what your clients can understand. Clients must understand what you are doing. They must be able to go along with you. And those fundamentals must be something that are unquestionable. They are not faulted by anybody and nothing work against them. So in respect of the title, we always put it that like, look, we assume that the title is good. But to what extent? Because before you make that assumptions, What do you call title to a property? In real estate or in assets ownership is a function of the title that one has. And well, we know that title could either be freehold or leasehold. Some of these ones also have some other lesser titles. And whether somebody is holding a freehold title or not, the right exercisable in respect of it is a function of this. But to what extent can somebody rights can take him home? What are the rights exercisable as owners? What are the rights? All this one has to be very well ascertained, and they must now be worded in the valuation reports for proper understanding. And of course, not only for proper understanding, for proper footing for our valuation, because what you value is the interest that somebody has. So what is the degree of interest? And that is why in looking at real estate as a PLU, that's proprietary land unit. So we believe that, or Professor Dema has argued that the number of things that we think they are physical are not physical. Because to an average valuer, the size of a plot of land, as far as it's concerned, is a physical thing, because he can measure it 50 or 60 by 120 feet. And he tell you that in an plot of land, and he plans on that. But in the real analysis of rights, that is not feasible. It is an infeasible thing to rely on size. Size is not feasible. Why? Because there could be some rights that you cannot see. Somebody can have a right of way. Somebody can have a right of light within a plot of land that will limit the exercise of the right of ownership in that land. And that's why you have to have a value that. So when you are now giving your assumption that your title is good, or you assume it has is being good, to what extent have you looked at it, where there are all other ones, whether there are caveats on it, whether there are restrictive covenants? Because in a number of real estate transactions, consciously or unconsciously, there are covenants that we make. There are restrictions. Those are the ones they refer to as restrictive covenants, limiting the exercise of powers of the owner. So there are inhibiting charges, there are mortgages, and all the other things. So it is so important before we now go and say, okay, look, we have assumed that the title is good. The title is marketable. The title is marketable, and there are restrictions, restrictive restrictions. How will you establish that? And you are put it down as a surveyor to say, oh, the title is good. So we should just go beyond that. That is the emphasis. That it's not just because, oh, we have seen that the man has a CFO in it, oh, the title is good. So it is expedient and it is expected of us as valuers to ensure that we understand and carry out proper analysis of rights, subsisting rights, and limiting rights in a plot of land before you now say, okay, you have assumed and you have now said that, oh, the title to this property is okay and is good. And before you now say, okay, the area of the parcel of land is 1 acre. I have said that. That's why under the PLU, Professor Dema has said that the fact that you have an acre of land does not mean you can make it as a decision unit based on that square acres or square meters that you have, until you understand the subsisting interests that are there, limiting interest, covenant, easement, and all other things. So you cannot just come up with your report and say that, oh, the title is okay. And you need to be careful, because clients are sophisticated now, they know what they are doing. And if they are not careful, so that a number of us will not be falling victims of the law. So there are so many assumptions that you need to do local search. So, and there are some that will require, the fact that somebody has given a CFO that you can see that, oh, this one is there, has not mean that he has not pledged it. Does not mean that he could not have there could not be some other encumbrances on that. So some of these ones make assumptions that it's okay, that you might need to go and do some local searches in the neighborhoods and really know who owns the land, to what extent it is, especially where there's no definite boundary and some other things. Then you also need to look at the fact that there are no statutory restrictions, charges that apply to the building. We also make assumptions on building survey. And what we are always, as valuers, what we always submit is the fact that we assume that we will now put a caveat that we have not carried out survey in respect of this and other things. This is okay because we are not builders and we are not carrying out building engineering survey. But in our assumptions, when you just assume that, the world over now has gone to the extent that if you will not be liable, then clients must be adequately informed of everything that has to do with the subject matter of their decision making. So if it requires that you get advice from some other professional before you can now say, okay, this one does not affect it. In a number of cases and in a number of valuation assignments, it is so important. If it requires that you have to look at, are there things that can affect the building substantially, or are there things that can affect the subject property, or that can eventually now affect the value of the property? Either you get it from local searches, you get it from your valuation inspections, or you get from other professional advisors, so that at the end of the day, so you as a valuer, you should be in a better position to be able to defend what you have put there. So that is very important. So then we also look at assumptions as to presence of deleterious or hazardous substances, like latent defects. And we always claim that we have not done this. But, well, some valuation assignments will not require that to do that. But however, where we have not done that, it should be properly couched and worded or structured in our, that we have not done this. But however, where this thing will eventually affect the subject property and your value, then the client must be so advised. So it is so important. It's not just that, oh, we have not done that, but where it is required that the client should go ahead and get that advice, then you should put it in your valuation report that, look, we have assumed this, but however, it is advisable that clients go ahead and do this one so that your valuation can stand the test of time. There are also assumptions, especially when you are dealing with income producing properties, because the expectation of every client is that, especially real estate, that there will be no vacancy, no void. Everything should be fully occupied. That's okay. We'll still talk about that later. But in your valuations, especially somebody who is buying, when you are valuing for somebody who is purchasing, you must be able to give advice in terms of the period that will be required for him or her to get vacant possessions, which means you must get information about that in the course of your inspections. Then, if he needs to purchase or do some other thing, how, in addition to that one, what will have to be, how and what will be required will have to be done. So if such assumptions do not accord with what you are trying to do, so, and if there are special assumptions that needs to be made, please, it is important that those ones are well structured. We must also, so like I've talked of contamination and other things, if it has been investigated, please get information to know that it is. But where you have assumed that it's not there, you have to be sure before you assume that there's no contamination to value. We also claim that, okay, assumptions are to the planning position, that is, and go ahead and be able to show the extent to which you have investigated. Either do that in writing or orally. To what extent have you investigated that there are no planning restrictions? To what extent are you guaranteeing? Because when you put it that way, we have assumed. Because assumption, when you are putting it there now, somebody is relying on your valuation report to make billions of naira decision making. And you just say that we have just assumed that this. And of course, at the end of the day, planning permission is not obtainable, especially when you are doing a development valuation. So somebody is doing it for development purpose or for the development. And you have now said that, oh, we have assumed that you get these ones. And you have gone ahead to carry out your feasibility and viability, and you have said, oh, no, the project is viable. Then at the end of the day, you might likely be sued either for negligence or for misconduct. So we must be able to show to what extent. So it behoves on us as valuers to be able to show the extent of the investigation. So which is confirming your assumption that there are no adverse conditions in it. To what extent can you prove that personal planning consents and planning approval planning approval will be given? So because once you have said, oh, there are no problems, and at the end of the day, the clients could not get that, so then there will be problems. So when you are calculating the worth, so you must well be careful, because we also talk about that later, especially when you are using the income approach, where you have to make a lot of forecasts and other things. So you look at, okay, what is the pattern of change in terms of your income, that is in terms of the benefits and costs. So because you don't just come in and say, okay, this is this. Thank God now, many clients are now even insisting that they want to see your procedure, your methodological procedure, what methods you have used and other things. So it is so important that we should be able to have evidence and get all these ones. The information we have relied on in terms of the details, tenure, tenancies, planning consent, and all these ones, I have talked about that. So they must be well investigated. And you have to carry out and ensure that when you are writing it, they are available and they are properly couched. But whatever you are now putting in there must have been investigated on time, on site. So if you are not well investigated that before you go ahead and put it there, then I don't know whether it can be called a misconduct or whether it will be negligence. Because when the chips are done, then there could be a problem. So you also need to indicate in your report to what extent verifications, assumptions, or what are they based? And the information you are using, to what extent are they material to what you are doing? So that's equally so important. So if it's so material that, oh, it can affect your valuation report, please, so indicate. So you have to be clear. So you should not be allowed for clients just to be making good conjectures or to be assuming whatever you are doing. Then I also say that, well, since our assets include plant and equipment in a number of issues, so you have to, when it is there, so you must be able to show what is really done and what has been excluded. And that will tell us that the importance of our letter of instruction indicating the scope of your work from the beginning. Because where that one has been obtained and you have the scope, you understand the area of coverage, you know what is expected of you, what is not expected of you. So there will not be problem here. But it is so always very important so that you get these ones done. And you also need to specify where you have not. So if no technical survey of condition of your plant and machinery have not been conducted, please let there be this and ensure that it is also done. Then there are some things we also don't take so much cognizance of in terms of statutory taxes levies. So some of us play smart by saying, well, look, the landlord will pay all the taxes or the charges are to be borne by tenants and other things. But before these ones are done, we must be able to know which ones are statutory levies and charges or by the owner of the properties, which ones are those ones that are to be borne. So by lessees, and to what extent have they been taken care of in your valuation assignment? If you have to take the issue of grant rent, for instance, so who pays that? To what extent have you found out? To what extent has it been paid? What are the liabilities? So what other things have to be paid? What other charges and levies are outstanding in terms of rates, tenancy laws, and every other thing? So all this one has to be done and to be well investigated. It's always also very important that we accurately capture, you see, our description of the properties. Don't just assume that, oh, the site is okay, it's all that thing. So some of us will only say, okay, look, the site is okay, it's level and other things. But the topography, the nature of it, the quality of the soil, and most of these things have bearing on what you want to do, depending on the valuation assignment you are doing. Like I have said, if it's for a development valuation now, and you are not careful of the technical feasibility of all these ones, so you have to look at it. Is it technically feasible? And all these ones, you have to take care of them before you now ask that, okay, you should go ahead on that. Of course, your opinion of value is there. So let me go to, because I'm mindful of our time. So these are some of the assumptions we do. Then, well, you also need to be careful before you insert the land registration number and the situations and put them there without really getting them appropriately. Some will rely on the valuers or the clients just say, okay, this is the things. So, but it is always better that we get accurate record. Even where copies of these types of documents are given, at times going forward to confirm so the accuracy of these things. So we save us some problems in a number of issues. That's why I say it's a function of what the type of assignment you are handling and the clients you are dealing with. So, and the level of sophistication of the client. So if you have something that you didn't find out and someone that just giving you, and you discover that the CFO that is given to you is a cloned one, then, and you have learned upon that, you put it down and say, oh, this is the thing. And it's discovered that it's no longer so. So some of these things will not be there. So we need to look at it. So since we make valuation reports and the opinion of value is used by different clients and is used for different purposes. So most of these things are used by lenders. Some of them are, well, even in Nigeria, I think most of what we do is that for mortgage purposes or lending and to take some other financial decisions. So those are the very common purposes of them. So we need to look at it as valuers also and be able to understand how to underwrite or model our income and the risk, especially in valuation that has to do with the income approach. But that's so important. A number of what we do is devoid of the risk. No, we are not so sure of the returns. Some of the returns that we look at is which is the income that we can just capitalize. So are not something that can stand the test of time. So in underwriting, we should be able to model, especially in investment valuations, when you are making your forecast in terms of the return. So that is so important. That's why I think I'm taking us to this side that modeling that is part of the assumptions you have to do. Have you properly modeled it? What is the risks involved? So in what you are doing, what are the returns? So because for every return, we have always been saying that the higher the risk, the higher the return. So all this one have bearing on the rate of interest that you will use. Because if the risk is so high, of course, you expect a higher rate of return. And if the risk is so high, but all these ones have to be modeled. and you have to be incorporated in your forecast so that when you are making your forecast, so the investors so would be properly guided and they will not run at a loss in whatever we are doing. So we need to understand that. So I have said that when we are doing that, because when I was talking on the other one, that it's important that as part of the assumptions, we should be able to forecast. And in fact, it's now a requirement from so many organizations now that once you are doing and they are submitting your reports, that you will be able to give advice and be able to advise on the vacancy issue. It is impossible that today the property is fully occupied. And that's why I said we must be able to model both the risk and the return. And to what extent will the property continue to be vacant? These are all things that we need to look before you now assume that the property is fully occupied and okay, look, it will be generating this income, and you now rely on that one and put it in your valuation model and you get your valuation report. So to what extent will it continue to be occupied? What if the current user or occupier moves out of the premises? To what extent will you be? What will be the rate of void? So all these ones help because, and you also, in fact, some of them will ask you now that you must be able to include in your report the vacancy factor as part of your cash flow for financial analysis. So it's so important. So if you don't know it, so you just look at, oh, I have a block of 10 stories building, you are valued it, and all of them are occupied today. What if the next 2 years, 80% of the tenants are no longer there, and you have now relied and you have forecasted that income for a number of years? So we need to look at it and be able to do it. Well, most often some people assume the standard frequency assumptions of maybe between 5 and 10%, but the important thing is that this is a major requirements now as part of the assumptions we made evaluation now for tenants. And not only will it establish or will it communicate to the clients that you know what you are doing, not only will it be able to establish the fact that you are defending their investment, it will only help them to more because you have told them the likelihood of this property not being occupied later or some other things like that. So that's so important. So you must be able to project what in focus. So what is going to be the likely vacancy factor? So it's now a major requirement. Not only in Nigeria, globally, it is expected. So please, let's look at that very well. Another thing you assume, especially once it's not being occupied or it's not being managed by the owner, management fee. Because if you look at it by the time we talk of the gross rent and you want to arrive at the net rent or the net income, a lot of things are so important. So many of us just say, okay, you deduct 10% or 15%. Maybe the example that a lecturer gave when we were in university. So that's registered in the minds of many people, and you just say, okay, look, just take 15% of this. But this thing should be scientific. That's why I said earlier that valuation is a science. So let's no longer go with that erroneous thing that, oh, those principles are what they learned in the university. Because it's a common saying that they will tell you that what they learned in the university is not what they do outside. It's either you are not doing it or we don't understand it. If you understand it, you must bear it, you must put it to bear in practice. Because that's the only way then what you are doing can stand the test of time. And especially in this volatile economy. So what this one is saying is that you must, in assuming your management fee, it's also a major part of the assumptions, which you will have bearing because it eventually determines so your arrival at of the net income. So if you use an appropriate rate, then you see that it increases the net income or it reduces it. And when it is reduced, there will be a problem. So then you might not be able to do that. So it's so important. That's about another assumption as to that. Then also it's also important now because properties more often than none. And one of the risks as far as real estate investment is concerned is because it incurs some costs, whether you like it or not. apart from the fact that it can be subject to depreciation and some other things, you need to maintain it and do some other things. So reserves. So there are always some requirements. So for you to be able to indicate what should be reserved to keep that property going, what should be the reserve? That is, we call it here, it may be like sinking fund, or you set something apart and have this one. But it's also an underwriting, because in focus, when you are forecasting, so when you are making your forecast, these are things that guide whatever you are doing. So you must be able to do that. What is the rate to which it should be done, depending on the property that is being considered at any point in time. So also, when you are doing these ones, I have said some of these ones, that the rental income cash flow. So to what extent can it be sustained? If you have said, oh, this property is 2 million naira today, and the assumption in the contemporary valuation method is that you will continue to be, the property will continue to be generating that property for life, especially if you are valuing, if it is a freehold interest. But the question is it sustainable? So you have to ask yourself as a valuer, is it sustainable? Well, we argue that property increases in value, which is okay. But happenings in the real past has vitiated some of these things. There are certain situations whereby now properties reduce in value. Depending on the number of things, anything can happen. What happens if the property refuses to generate the income again? So it's part of the underwriting assumption is for you to be able to establish to what extent will you be able to sustain the current rent, and when you are now making future projections, to what extent will you do that? So please, let's take that one very seriously as part of whatever we are doing, so that, because our input now, especially with the influence of the Financial Reporting Act working and mandating us or requiring us to work along with other financial professionals, so to be able to have our input in other financial statements, it requires that we must understand what we are doing and be able to speak the language they speak, in terms of that we should be able to get clients convinced of all that we are doing, the data that is being used. So what assumption are you doing? So in terms of that rent, is it sustainable? And if it is sustainable, to what extent? And then what is the extent of envisaged impact that it can on the rent? Is it something external or something within? So you don't have time to be going into all the ones. So I have talked of the need for us to be able to estimate the vacancy rates, because annually you should be able to say, okay, look, this property, though it is fully occupied today, so tomorrow, will it still be fully occupied? Will it be occupied by the owner, or will it be jointly occupied with the landlords at this? How many floors are occupied today? Tomorrow or the next year, how many so will be vacant? So we must be able to say, okay, look, what is the chance of annual rent loss for it? So all these are the assumptions we make, because it's not just that we are forecasting or we have obtained a comparable. That's why I took us to all these ones. That okay, similar properties commands 2 million naira. So this one also should command 2 million naira. So that might be very wrong. So we look at that one. Then there is a need for us to be able to estimate the maintenance cost. And this one depends on the condition. Old buildings might need more money to maintain, whereas in new buildings, little might be required. But in buildings that are already aged, so we might need more than that. So depending. Well, some will tell you, okay, look, if you estimate about 10% of the annual, but then it's a function of maybe the age, the condition of the building as at that time. So, but what we need to do is we need to understand that we need to look at capitalization rates. In fact, it is now being a requirement in some organizations now asking that you have to put your capitalization rate. And you can see that things have changed now. So this post-COVID-19 era has changed a lot of things. So frequency rates seems to have increased more than it used to be because of a lot of things now. There is now people who co-work. There's the concept of co-working where people work together. There is the concept of working from home and other things. So having bearing on especially commercial property. So when you are dealing with all those ones, it's important that you have to be able to look at it and get proper capitalization rate. I have explained that when I was looking at the other one, that your capitalization rate is an important factor. So if you want to adopt the income approach. So where you are dealing with an uncompleted building, or where an aspect of a building in a property seems to be uncompleted, so you should be able to estimate. So whether from your own experience, whether you get input from other professionals, you must be able to estimate what's the completion range, when will it be fully completed, and what's the effect of this non-completion or the stage activities now, and be able to do this one. Then it's also expected that you must be able to make proper assumptions on your discount rate or your discount factor. I think we have talked about that one, so it's so important. So other things, because like I have said that assumptions are so fundamental to the accuracy or otherwise of your valuation, your opinion of value. So you must also be able to understand, and all these ones, some of these ones have to do with the use of the income approach. And that is the best approach, especially once we are dealing with income producing, or the one that we can deduce income from. So once you are doing that, we must look at that. So we also need to make assumptions when you are making projections into the internal rate of returns. And this one takes into consideration the time value of money. So in order to generate a return, what's the internal rate of return? And that is the discount rate, so which is required to bring an investment future worth into line with its current value. And if you do the calculations, we said it must be usually equal to 0. But we must understand that because this is not the class for that, we cannot go into that. But please, it's an assumption that you will be able to look at it to be able to make so accurate and reliable projections. Then there's also the concept of cash on cash. And this one measures, when you are making assumptions of these ones, the amount of cash flow relative to the amount of cash invested in a property investment. That is cash flow. If I have infected 2 million naira, or a client has infected 2 million naira, what cash will you be generating? These are some of the assumptions we make. I know we are in a cashless economy, but however, the concept is what we need to understand. That we know that, okay, look, from these ones, how can you be able to model that? Oh, from these cash flows, this is how much that will be generated, especially bearing in mind the fact that it is assumed that the fund for property development is always from borrowed funds. So it's not from equity. So when you are now, when you are now use debt financing, so this one is so important. You are borrowing money from the bank, you must know how much will come in, how much will be required. So that's a concept of cash on cash. And it's a matrix which measures only the return for the current period. So you look at it on a yearly basis. For this year, okay, this is how much we get from how much we have invested. So this one does not measure the entire life of a project. The another thing that is also important is equity multiple. This is another assumption that is important for us to do, especially when you are doing, when you have to do with real estate investment. And this one is defined as the total cash distributions received from an investment divided by the total equity invested. Yeah, I've said the total cash distributions received, all monies you have received from all sources. Remember, on cash, when you say that, how much cash will you get from this one? But if from this, because when you are talking of portfolio investment and other things, and you have to value and get this thing done, then from all the multiple sources. So how much money from all those funds will you get, or will an investor be able to on the initial investment? That is on the initial investment that he has made, how much will you be able to get? So that has to do with an assumption as to the equity multiple. So it's also so important that we should just go beyond just saying, oh, we have made these assumptions and we are these ones. So I think these are various assumptions that are so important for us, which we also need to get very well, get worded. We should be familiar with them, and we should be able to word them well in our evaluation reports. So for better understanding of our client, and especially when we are dealing with corporate or financial literate and well sophisticated clients who understand whatever we have done. So I want to thank you for your time and welcome contributions. I know many of our guys are online that would bring their experience to bear on the number of things we have said. So I will be standing here. So I want to thank you for your time. Thank the organizer for this opportunity, where I allow all our very senior colleagues and well-experienced professionals to contribute to this. So thank you very much.
Thank you very much. Thank you very much, Estate Surveyor and Valuer Associate Professor Tunde Oladokun, for the wonderful lecture. Thank you so much. We didn't expect anything lesser, because you're one of those that showed us the roads in estate surveying and valuation, and we know your capacity, we trust, and we are always proud of you. Thank you so much, sir, for the wonderful presentation. Now, we will go to question and answer session. But before we do that, I want to encourage everyone who has listened to this lecture to send their questions. There are questions, I think there are about 4 or 5 questions in the question and answer session already. Please, let's keep the questions coming in. We are going to take them. But before we go into question and answer, we have some of our senior members of the profession online, and our practice here is that when we have our webinar, we look at those seniors, especially the ones we have today. They are like people we can call father in estates. Some of them are father in estate surveying and valuation, those who taught us, who showed us the road. And we have a couple of other members of the profession and members of the board who are also here. We want to recognize them. And I will start by calling Professor Estate Surveyor and Valuer Professor Abel Olaleye is online. I want to thank you for attending this webinar, sir. And I want to tell the admin, kindly promotes Professor Olaleye to be a member of the panelists, please. Admin, kindly promotes him to the panelists, to be a member of the panelists. Thank you. Then, at one point, I also saw Estate Surveyor and Valuer Akin Tomide Akinlabi. I think he's the NIH representative at International Valuation Standards. I don't know if he's still in. Admin, kindly check if he's still in. Promote him to the panelists, to the panel room. Then we also have here the registrar of SVABON, Estate Surveyor and Valuer Janet Shehu. Admin, kindly check if Estate Surveyor and Valuer Janet Shehu is still online. Kindly promote her to the panel room. We have online also Estate Surveyor and Valuer Fatima Aderele Oluokure, another senior member of the profession. Admin, kindly check and promote her to the panel room. Thank you so much, everybody. I also want to appreciate our valuation lecturer at Risk Academy, the faculty member, and other faculty members who are here. I saw at one point Estate Surveyor and Valuer Bashir Rahim. That's the valuation, the head of the valuation department at Risk Academy. Welcome. You can admit, you can also promote Estate Surveyor and Valuer Bashir Rahim to the panel room. Thank you. Okay, now, while we are waiting for more people to join the panel room, I don't know who has joined and who has not joined yet. Okay, while we are waiting more people to come in.
Madam and Aderele Oluokere and
Oluokure.
And
yes, she has corrected me some time ago. I think I'm not taking correction. Oluokure. Please, Oluokure.
Okay, sir. Noted, sir.
Then what about Professor Laleye? Is he still online?
No, sir.
Okay. What Estate Surveyor and Valuer Janet Shehu. Then Estate Surveyor and Valuer David Marcelli. Please check if he's still
not online anymore.
Not online anymore.
Yes.
What of Estate Surveyor and Valuer David Marcelli? Not online too?
Yes, but I promoted Matt and Shehu Janet, sir.
Okay. Yes, she's still online. Please keep sending. I think when one gets distracted, you may not know that. Okay, now, while the lecture was going on, while we are waiting for other people to join the panel room, there are certain things I want to call our attention to. You know, there's something my mathematics teacher used to tell me in those days while I was in secondary school. When he gets somewhere, he teaches us mathematics and he gets somewhere, he will tell you that take this as a memory verse, you know, something that you must hold and you must hold dear in carrying out your assignment or in doing any kind of activity that you must not forget, or you allow it to guide you as you go on. I was able to note 2 or 3 things that I can refer to as memory verse for today's or some of the memory verses in today's webinar. Number 1 is the lecturer or the facilitator made us to know, or made us understand during his lecture that assumptions are fundamentals to the appropriateness or otherwise of opinion or value. That is to say, when assumptions are appropriate, when you make assumptions very well, then you are close to the appropriate opinion of value. Then the second one is that any issue capable of affecting your opinion of value, okay, whether within or outside the property, should be captured under assumption. 3, issues should be thoroughly investigated before making assumptions on them. That is to say, he made it clear during his lecture that you don't just say, oh, a road property is subject to road widening, or it's not subject to road widening, and you note it in your value. Have you investigated? It must be properly investigated before assumptions are taken on such assumptions are taken. Then he also mentioned that he mentioned issues like modeling risk and return in our valuation and appraisal. I want to say that there is a model. DCF model is very, very in this area. And I remember that when our director of study carried out a particular valuation post-COVID, and it was to capture the effect of COVID on the issue, DCF was used. I want to see points it's coming on counted cash flow. All the things, majority of the things that were mentioned here today by the facilitators are going to be DCF asked for. And as a result of that, I will encourage all of us here to try as much as possible to be part of that training. It is for you, it is for our profession. For us, it is for our profession. I know at the end of the day, all of us will be good for it. So let me go to.
You want to improve yourself if you don't learn every day, irrespective of the fact that I am not practicing. I need to also be in tune with what is going on to be able to be best at my job. I want to thank you for the privilege and for putting this together. And I want to thank Professor Oladokun for the lecture. Assumption has always been a major issue in most of the valuation reports that our clients present or our colleagues present to clients. Most times, area of disagreement stemmed from the assumption. Either we are not looking at things from the same perspective, or they misinterpret the assumptions that we have employed in arriving at our opinion of values. And so I think the lecture is up, and I want to encourage that the material be made available in soft copy for those who are not able to join, to be able to look at some of the salient points that Professor Oladokun has raised in his paper. I think I will leave that as an opening remark while we go into actual discussion. Thank you very much.
Thank you so much, Ma, for your comments, and thank you for always making out time to join our webinar. We are happy to have you here. We have the whole of the profession, representative of the whole of the profession here. We have a representative of Exvabon, even though not representing Exvabon in this capacity, but at least is the registrar of the, as deputy registrar of the board. And we also have some senior members of Estate Surveying and Valuation, or Nigerian Institution of Estate Surveyors and Valuers. Okay, let me go to Estate Surveyor and Valuer Fatima Adenrili Uluwokure. Let's have your comments. She's still there. Estate Surveyor and Valuer Uluwokure, please.
Hello, good morning, everybody.
Morning.
My
Welcome,
noble colleagues. Thank you very much. It's always a pleasure to be part of a learning process. We have all, reviewed what we have gone through in school and what we come about in practice. And I've actually learned one or two new things in addition to what one knows already. So thank you very much, Professor. It was a good one. Apart from seeing some dollar signs in your write-up, which I think can be replaced with the Naira sign, let's be proud of our currency. I've learned a lot. Thank you very much. And we hope that we will be invited in subsequent webinars. Thank you very much. Welcome, everybody.
Yeah.
Thank you.
Thank you so much, Ma. Thank you for your comments. Thank you for your time. Let me quickly hear, let's hear from our head of valuation. I think he's also in the panel. Okay, yeah, Estate Surveyor and Bashir Rahim, please, in 2 minutes.
Hello. Hello.
Yes, we can hear you, sir.
Okay. Hello. Thank you very much, yes, Kamaruddin, for the privilege. Let me first and foremost thank our Professor Oladokun for very impactful and highly educative lecture. He has made us to understand. Anyway, assumption, as the case may be, he he has made us to understand is different from our usual practice of just stating the assumption, irrespective of not taking into cognizance the appropriate suitability of those assumptions into the specific assignment we are doing. Because we all feel like a land and building, for example, we all feel that the usual 5 or 6 assumptions that we used to state are the limited or the only required assumption for valuation of land and building. Whereas when you are doing some valuation, some a specific property will require additional assumption, as being stated by our erudite professor. So this is the time we begin to know that every step we are taking or every assumption we are making needed to be, included in our report, so that if anybody, even a layman, picks up our report, he will be able to say, he will be able to, he will be convinced on what parameters we have, used in our report. I must thank the prof for, taking us this far, opening our eyes, into those, nitty-gritty as per the assumptions. So I think we needed to inculcate everything Prof has said today in our practice. If we have been doing it, let's sustain it. If we have not been taking into consideration those special assumptions peculiar to each property, if you have not been taking them into consideration, let us begin to take them into consideration. Thank you so much, our professor, for the lecture. We thank the academic too for the organization of this lovely training. And we thank our sponsors too. First, Vice President of the institution, ESV, Victor Alunge, for sponsoring this lecture every time. I think this is the 6th series. So from 1 to 6, and it's not relenting, so, sponsoring further. So let us all thank him for being with us and for having the profession at heart, that he wants people to, learn, to improve in their professional ladders. So thank you so much, our first president and first vice president and the RIS Academy. Thank you so much, our moderator, for your effort every time. Let me rest my comment at this level. Thank you so much.
Thank you so much. That was our head of valuation at RIS Academy. He also added to what Prof said. He said, trying to re-echoing what Prof had already said, saying that not just listing those 5 assumptions. Those are any assumption you want to make must be suitable to the property you are valuing or the assets you are valuing. If it's not suitable, it doesn't have a place in your valuation reports. Okay, what we find most times, assumptions will be listed, but many of them are not investigated. Many of them are not even suitable to the assignment at hand. So thank you so much for that. Okay, we will now go to question and answer session. Here we have a few questions. I will try as much as possible to harmonize those that are close, that are almost the same thing. Okay, number 1 question from Rashid Alimi. Prof, how do you want to take it? Should I take them one after the other?
Let's take them all together.
Okay,
all right. I think it's better because of our time. All
right, sir. Okay, so I will read all, then we can you answer them together because some of them are actually close. Okay, then good day, sir, from Rashid Alimi. What are those basic things that should guide us in structuring assumptions in different valuations, e.g. insurance, rental, etc.? Then there's another one from Olajide Oladusu. With the approaches, it looks like the arguments have not taken cognizance of the location, as it is believed that each location has its own peculiar advantage and disadvantage. please educate on these aspects. Then we have Olivia Umi. Say, please, can we get, okay, this, yes, you can. I think I've answered that. Then Miriam Afusat, Miss Olivia, you are going to, you will get it in your email. You get the presentation in your email after this webinar. Miriam Amusat, please, can we have, okay, same question. I think that has been answered. Please, sir, what is the difference between assumption and special assumption? Okay, what is the difference between assumptions and special assumptions? Okay, then we have this from Sulaiman Mohammed. Good morning, sir. In valuation for compensation purpose, why is injurious affection is often not considered as, why is injurious affection not often considered as a claim? I think that is what the person was trying to say. Then we have from Samuel Adejoro. Okay. Samuel Adejoro said, this is wonderful. Okay, yes, God bless you, sir. My questions are, under methods of assessments, replacement cost and reproduction cost was talked about. Please, I want to ask. Okay. Sorry. Please, I want to ask, trying to see. I want to ask about reproduction. Can it be said to be historical costs? So what this person is trying to say is that we mention reproduction and replacement. Then he's now asking about reproduction, that can it be said to be historical costs? When can it be used in valuation? Then, to me, I think replacement cost is to be used since we assess properties to determine the present worth. Okay, I think you have asked your question about reproduction. Number two, he said, on assumptions, looking at the time duration for delivery of reports, how can most of the stated assumptions concerned with the peculiar asset be assessed? Okay, maybe he wants to say be investigated. Okay, that's giving the limited time for delivery of assignment. Then how can those assumptions be investigated within the limited time? Then another one from Olatunji Oluwashiu. Our presenter make more emphasis on investigation before we make our assumption. I want to ask, sir, what shall we do when what the client wants to pay for, when what the client wants to pay is far lower than the cost of producing the reports? So this is just, this person wants to know that giving the investigation what has to do before making assumptions, that's considering what the clients, what some clients pay, as low as the fee, the low fee they pay, that's how can we manage that? Then I have a question from, okay, Akintomide Akilabi, good morning and thank you for organizing this webinar, and thanks to Associate Professor Oladokun for a well-packaged lecture and eloquently delivered. Please, am I permitted to use the lecture material for our branch members? Okay, I think this is to the academy. Okay, I think let me just answer this straight away. To use the material for any, so long as it's going to be for the purpose of knowledge sharing. I think the idea behind this webinar by by Risk Academy and our co-sponsor is to make knowledge available to the people so as to better the practice of our profession. So Risk Academy does not have any objection to that. Please Estate Surveyor Ambala King Tomide Akilabi, you can go ahead. Let it be shared. Let people have the knowledge. It is for the good of our profession. Then I have the last one from Olawale. I don't know if this is a question. Legusi said, sir, this is for our experienced and senior colleagues. Are there heuristics or guides for adopting assumptions in valuation reporting? Are there heuristics or guides for adopting assumptions in valuation reporting? I think these are all the questions for now. Thank you so much, sir.
Thank you. Yes, Lawal. Well done. You have been doing so well and so great, and I appreciate everybody who is well with us. Nobody is an island of knowledge, so that's why I will answer it to the best of my knowledge, also expecting more people to contribute anyway. But let me first start with the last one, whether there is heuristics, has to do with human behavior. How behavioral, because it's part of the behavioral aspect. People have researches into behavioral aspects of our valuation so much. There are so, in fact, I know many works have been done on that, heuristics and so many other things. But if you remember when I started, I said we believe that evaluation is both an art as well as a science. So, and that's why the behavior, the experience, and some of those ones still come to play. But however, what we are saying is that even if you use experience, please base it on proving scientific theories. So it might be out of place to just tell you that, oh, this is a formula when you are behaving and you are doing this. But however, the emphasis I said is that please get the purpose right, understand what the client needs, then get appropriate methodology. Now let's correct appropriate data. But when you are not doing all those data, because you make assumptions at every level. Then when you are even discussing with your client, getting instructions, you start from there, making assumptions. What does the man want? When you want to develop your basis of valuations, you have to assume, oh, this is what the man wants. This is a value concept that explains what he wants. The man wants to ensure that once his property is destroyed by fire, he wants to get new property. You say, oh, the man wants, what he wants is a reinstatement basis. So, but all those ones should be scientifically proven. So for it to stand the test of time and for it to be excellent, so and to be able to stand the test of time. So, but it is you, however, experience comes to play because when you have been doing something over sometimes, you have some of those ones, and that's the art aspect of it, where you use your experience, where you have to know fit and do things well. But however, so what drives the art should be the principles, should be the understanding, the science of it. So please, that's the way I want to look at that one. But it's in terms of the extent to which you can make assumptions in view of maybe the paucity of fund or the fee that is paid. Well, we must also know that, number one, as practitioners, we are out to make money, no doubt about that. But number two, we must also know that our knowledge and the quality of service delivery helps us a lot to get money. The more knowledgeable you are, honestly, the better it is for you, even in practice. But once, you see, we have been talking of incursion of quacks into our professions, and people have argued a lot. But the issue is, we have said that law cannot help us. What will help us is excellent service delivery that will make us to be able to do things better than they are. And clients now know that, look, they can get better things for us here now. So, well, why we need money, I still believe that you need to get, once you do quality today, even though you get little money, that can bring about a revival of a job that will now be better off and place you even where you never thought. But while we must not undercharge, of course, we have scale of charges, but we must go by that. But in as much as possible, please don't let us compromise what we need to do, because that is what stands us out. That is what displaces our competitors. The environment and the market is now very competitive that we are now battling with engineers. That's why I talk of client sophistication. We are now battling with them now because they have the knowledge. In the universities now, engineers are taught valuation principles. They are now taught quantity surveying, surveying students are taught, they are taught principles of valuation now for you to know. So they are preparing themselves for all this one. So if you will now do well and be able to do better and satisfy your clients, you must know more than those ones and be able to do better than what they need to do. So please, that's the way I would do it, that as much as fee is important, please, let's know that we don't compromise the procedure and standard in whatever we want to do. So that will help us. And somebody asked about assumption that the time for us to do that how do we do it? Assumptions, we said that, well, that's why I said that in making assumptions, yes, you said somebody will be able to get this money and to what extent. So we need to ensure that we get it right and that assumptions can still stand the test of time for a foreseeable period of time and for a number of years, so that whatever we have given today, even though an opinion of value, so that's why the date of valuation we have argued and is believed that is the date of carrying out our inspection. But at the same time, it is expected that the parameters that determine what we do that day must be such that, of course, stands the time of the test of time. It stands the possibility of anybody faulting whatever you have done, because it makes a professional to look foolish if somebody just say, okay, look, you said we will get this 2 million naira for 2 years, but the following year we cannot get 1.9 million naira. So that's why all these assumptions we are doing, or you have said that, okay, there will be planning permission. Unfortunately, you have not considered maybe the change of government and some other things. What is government policy that will not now say, okay, government will no longer approve such projects and other things. So we have to look at all those ones and ensure that they are well done. Somebody was asking whether replacement and reproduction is tantamount to historic cost. I didn't say it is historic, and it's not historic cost. But what I said is, the way you are replacing today, all you are saying is, okay, look, we want to build this building today with new technology, new materials as at today. But the other one is, okay, look, well, we are still reproducing. You want to get, even though something that will give you the same quality and other things. But with the design they used as at that time, with the kind of material they used then, today someone could have been making use of. Now, in some years back, there was no tiles and other things, no, some of these finishes. But when you are reproducing, well, you are looking at, okay, you want to reproduce what they have. Even though you are thinking of how much it will cost today, but reproducing that. But in replacement, you are thinking of using current materials, current technology, current design to get what you want to do. So which you will now apply your depreciation to be able to get whatever you are able to do. Somebody asked about compensation. You see, the understanding I have about compensations is that we say there is what they call statutory valuation. One of them is compensation, then there is taxation. It is statutory because it is the law that specifies the basis and the method. And in fact, in some instances, the procedure. So the procedure to adopt is already contained in the law, and you cannot do anything against that. And that's why injurious affections and other things, as are today, so most of them are not taken. And that's why people have written papers and they have submitted the fact that the compensation we give by virtue of the Land Use Act is inadequate. So, but once you want to talk of adequate compensation, and that's why people have been saying and echoing is that for as many of us who have influence on the government, all we need to do is to ensure that the Land Use Act is removed from the Constitution so that it can be amended. So the current law as it is now, does not take cognizance of that. The law says that if you are valuing land, oh, it should be a refund of the ground rent. So you can't do otherwise. Because if you go to court, there's nothing that you want to use it. Even though there are still some other laws, but the current one that is popular is the Land Use Act. And the law is saying that if you are using the building and other improvements, unexhausted improvements, that you should use DRC, that is depreciated replacement cost. So it is the law that is defective. It is not because we don't know the methods or how to do it. But there are various ways by which you can capture all those ones in valuation. So, but because it is statutory, because it is law, for your information, the only law that says it's supreme to our constitution is the Land Use Act. The Land Use Act says that no court of law can entertain any suit in respect of the exercise of the government's power as he exercises it under the Land Use Act. If you go to court, you cannot win. So you can only win as long as you are saying that, okay, look, this is what the law says, and that's what the government says. So it's the only law. So terrible a law that is saying that the no court must entertain anything as long as that one is concerned. So the compensation is not adequate because a lot of things are not taken, disturbance is not taken into that, and it's not taking cognizance of injurious affections. So severance and some of these other ones, they are not there. So I think that is the answer to that one. So in terms of vacant possession, I don't know what the person is, but what we are saying is when you are making forecast, it is required that you should be able to know, oh, this property is likely going to, because when you are using income approach, my guy has said that by the time you are going through DCF, you will understand it the more. And I will encourage all of us to still attend that one. So because that one you are now focusing, making your decisions and your focus based on current income and expected future income. So you have to project. So when you are now projecting, it might not be that today, because it is fully occupied, that tomorrow it will continue to be so. So that's why you should be able to have your market analysis and look at it. By the time you look at the 4 years, so you can be able to come up with vacancy factor for that property that, okay, within the next 3 years, going by the trend of things, about 10 or 15% of the rooms or the offices will be vacant. So, and the money will not be coming in there. So that for it, will look at that. So I think that is what we are trying to say in that. It's not that, oh, you can just assume that it should be vacant. And the other one I said is that you should also be able to make assumptions as to if you are buying property, you are buying for valuation, or somebody wants to buy for purchase, you should be able to let him know that within a period of 6 months, 1 year, oh, he can get vacant for possession or not. So you'll be able to do all those ones. So I think that's what we have said in some of these ones. Somebody said, because we said there are assumptions behind these ones, it does not take cognizance of locations. It does. Location is important. It's an important factor. But all that we are saying is, it's not the only one. When you are looking at valuation, 2 properties within the same locations by each other might not have the same value. So because of a lot of things. So apart from maybe the designs might be different and other things. But we are only saying that if you are using cost, for instance, now in the Ikoyi, fine, you know the land value over there. But however, the fact that before you now say these properties was 300 million naira, you must know that, okay, a buyer wants to buy because you want to predict how the buyers will behave in the market. You must be able to establish that the man, if he has an option of buying similar property that will give him within the Ikoyi for 200, he will not buy your own for 300. And that's why that one should be the gauge. It's still within the same location. So, but he can get an alternative. That's why I said the logic behind that market value is that, oh, somebody can get it purchased, another one, the same design, the same quality, within the same neighborhood, you will get it for 200 million naira. He will not buy it for 300 million. So if you now place a value of 300 million naira, that margin of variation is too much. So it's too much and it will make mess of whatever you have done. I think those are the things. So maybe we can still allow people to contribute. But that's those are the various fundamental assumptions underlying all those ones. But I emphasize the fact that you just must know that behind those methods, there are assumptions why it is used. So that market approach will tell you that, oh, rational buyer will not pay more than what will get him to purchase a similar property within the same location. So he's still talking about location. It's not that location is not taken about. And that if he's talking about income, your decision to buy will be based on what is the present and future income brought together to now say, okay, this is the value of this one today, after you have discounted that using an appropriate discounting method or factor. So still talking about in that location, but he must now consider that in these locations, what will the property be able to bring as income for a number of years. So I hope that satisfies the questions.
All right, thank you so much, sir. Thank you for the well-articulated responses to the questions. I don't know.
Sorry, sir. Somebody asked questions about what will guide basic things and guide assumptions. Well, we have said it that assumptions is a number of what you are dealing with. In fact, your client, you must know what your client wants before you go ahead and make assumptions. So the purpose of valuation is important. That's why I talk about that. And the methods, the basis, is just because we don't have the time. That's why we didn't go into all the basis of valuation and other things. But you must know all those ones determine it. And the property in question. So the assignment, the nature of the assignment will still determine what you do. So, and since the purpose is the valuation you are giving what you want to do, then it will not be, oh, all this one will not determine the assumptions you want to make. So the assumption you want to make. Thank you very much.
Yeah. Thank you so much, sir, for the well-articulated responses. Because of our time, I don't know if any member of the panel room has anything to say. Otherwise, let's anything, member of the panelists. Okay. While we try to bring this program to a close, I want to quickly draw our attention to what I mentioned earlier. You see, most of the things that Prof mentioned today in this webinar, like the issue of capturing loss in rent, capturing shock in the market, and try to know the exact situation, the state of the property and the economy within which that property is. Okay, discounted cash flow is a handy tool, and this model is such that it makes the job to be easy. We have a training that I mentioned earlier. This training is just not a training; it is a short course on the discounted cash flow valuation model, which required Microsoft Excel skills. So one thing you must know about this is this is not a one-day MCPD. This is for 5 whole days and weekend, Saturday and Sunday. And the way it is run is that because it requires 2 things. You have the knowledge of Excel, how to use Excel to be acquired on one hand. On the other hand, the knowledge, the refresher class on property valuation is also part of it. And the third leg to it is now how to use this Excel tool, how to use the DCF tool to be able to solve life valuation problems. Okay, this is very fun. If you look at what we have here under the training objectives, we have refreshing participants' knowledge on the use and construction of valuation table relevant to the application of discounted cash flow analysis, understanding the fundamental principles and theories of discounted cash flow for property valuation, to develop the skills in the use of Microsoft Excel. Many of us we are not acquainted with it. And Microsoft Excel is not just only useful in valuation, it's useful in every facet of our practice, even in property management. Okay, then to reduce likely human error in property valuation analysis and be able to work faster and better. A measure to test for uncertainty in opinion of value, to test for uncertainty in opinion of value. This training will also afford you that. Then to encourage and ensure thorough analysis in property valuation process. Okay, thorough analysis is the only thing that can make us to be very, very apt in our opinion of value. But once the analysis is not thorough, once we don't do our investigation very well and our analysis are not thorough, it becomes an issue. Turning out, giving our opinion of value may not be rooted in science, just like the professor said earlier. Ability to conduct sensitivity analysis. Okay, I know this will be new to many of us. Sensitivity analysis, what we know is in project property development, we say, or in appraiser. That's where, but it's also, we also use this here to conduct that even for in the case of valuation, because the world we have today, clients are now demanding more than what they used to demand. So it is not a time to just rely on what we have always known. It is the time to unlearn and relearn. Okay, know how the practical application of the technique, how to know the practical application of this DCF model. Then this training will come up, is, like I said, is for 5 days, and it is going to be for a period of between 18th March to 1st April. And the time is 10 a.m. to 4 p.m. on Saturdays, and 2 p.m. to 6 p.m. on Sundays. This is a physical class. It cannot be done online, okay, because it is a class that every participant is going to be carried along, okay? When the instructor takes a step, okay, you are expected to also take the step, and the instructor will ensure that you know how to do it before it moves to the next stage, so that this is a proper course, not just an MCPD. Then this one, we are doing it in Lagos. We also have people who have requested from other locations within the country, and as much as possible, when we get the required number, we are ready to move. We can come to Port Harcourt, we can come anywhere in Nigeria, so long as we have the required number that can make us break even. We will come there to carry out the training. So thank you very much. And on this note, I want to call on our directors of studies, Estate Surveyor and Valuer. Okay, I didn't mention the training fee. The training fee is 100 naira. Sorry, 100,000 naira. 100,000 naira. Okay, please save money. You can pay 3 times before the program. You can pay 5 times before the program. So long as you are making payment, we know how the economy is now. But I can tell you that the knowledge you acquire is far more than 1 million naira. By the time you start using it to solve real life problem, you can pay in several installments before the date of the program, so long as the payment is completed before that day. So thank you very much. Our director of study, we give closing remark because of our time. Today is Tuesday. So Estate Surveyor and Valuer we help us do a closing remark, and let's quickly have that from him. Thank you so much. Okay, before we go into that, I want to say this particularly because of our candidates who are currently doing the classes for, classes for the NAIF exam, who are currently in the preparatory class for NAIF's May-June exam, professional exam. You see, our emphasis has always been at Risk Academy that don't mind those who tell you that practice apart, theory apart and practice apart. Don't listen to them. Professor Ladokun said it, that it's either one of two things can happen. It's either that we don't know how to apply the theory in practice, or we are not even sound, our theoretical knowledge is not even sound enough to be able to appreciate how it can be applicable in practice. So there's nothing like theory apart, practice apart. That has been our preaching. You have heard it from a professor of estate management, and I'm sure it's going to stick. Thank you very much. So, Estate Surveyor and Valuer, please, closing remark. Hello?
Hello, sir.
Yes.
Yeah, we are trying to connect it, sir. Is service on here? We are trying to connect it, sir.
Okay. Okay, let me. Okay, just a moment. Let's have him in for the closing remarks so that we can put this behind us. And while we are waiting for him, I want to also say a word from our co-sponsor, Estate Survey and Valuer, Victor Adekunle Alunge. He said he was supposed to be at this program, but because of the assignments of office, the national level. So he sent a message to us that he will not be able to join us today because of other assignments that he's doing for the institution. Okay, but his words to us is that the primary objective is to ensure that it's not just enough for us to come for this training, listen to the facilitator. Oh, the facilitator is fantastic. He presented well. If at the end, if the facilitator presented well and is fantastic, and at the end of the day, and after the training, we cannot ask ourselves, what have we learned, and apply same to the betterment of our practice. It has not achieved its purpose. So he said we should try as much as possible to apply this in our practice so that the essence of the training or the essence of the webinar will be achieved.
Yes, sir.
Okay.
The director of audit is on now, sir.
Okay, all right. So let's have your closing remarks, sir. Thank you.
Okay, thank you, Ezra Commandant Lawal. Thank you for a wonderful job. I want to say good afternoon to each and every noble colleagues here present, particularly my professor, Professor Tunde Oladokun. We cannot expect anything less because he has ever been highly impactful and committed to capacity building. So we appreciate you, sir. And all other professors in the house, Professor Abel Olaleye, erudite professor, and senior members of the institutions and the entire noble colleagues, we appreciate your time. In the first instance, I want to say that the essence of our webinar is not just to come and mark time. And that's why we are so passionate about it, to make it free most of the time. So the only value from it will therefore be how it's contributing to a bottom line in our various practices. And number two, that is equally why it is not just 10 minutes, 15 minutes presentation. It is usually a section that will require about 1 hour plus, between 45 minutes to 1 hour or 1 hour plus presentation, so that we'll be able to have take home. This is very, very important because the essence of attending webinar, seminars will be defeated if there are no take home. Today, our respected lecturer has given us a lot of thesis and have been able to explain, laid good background for us to understand that assumption is not just something that is generic or something that you can always copy. Without wasting your time, let me share with us one or two experiences. There was a time I had the privilege of sitting as a sole arbitrator on an arbitration case. And we required to have expert opinion, expert witness, and among which an SSV and Valuer was invited. one of the areas in his report that put him on his toes, that the lawyer to the respondent was able to really hook him on, is the aspect of the assumption. Because actually, the set of assumptions in that report, as we normally copy, did not in any way speak to the assignment, speak to the required figures, the required opinion of value. So let's put this in mind. Our assumptions should always help our readers to understand what our opinion of value is, why it is what it is, where are we coming from, and why are we at where we are. And these have been so much emphasized by our professor today. So I want to thank him once again for the wonderful job. Now, let me say that this is the last series of this webinar. It was packaged as a webinar of 6 series, and this is the last one. I don't need to start emphasizing that it's been sponsored by First Vice President of Naives, in person of ESV Victor Alonge. But I need to mention here that others, we have other packages that we are working on. Education is not cheap. This is why even this series we say, because it's subsidized, it's grossly subsidized at our end to ensure that we were able to attract sponsors. And thank God for the passion and interest of the First Vice President that had made this a reality. So I want to equally appeal to each and every one of us, and you can equally appeal to each and every other members around you, that let's team hands together for the betterment of this profession. What I can say is that our profession is very broad and it's knowledge-based. So we need for us to practice and be able to fulfill, to comply with international best practice, we need knowledge. And I need to say that is problem of knowledge or mastering of our skills and experience that make us to believe that is theory apart and practice apart. As we always emphasize, there is nothing in theory that will not have application in practice. My own understanding of theory is that they were born out of series of observations of the practice, out of research, out of tests of hypothesis, before they now became theory. Now, applying them by, why would they be problem? It's basically because we don't have the understanding right from the beginning. What you call theory, you don't even understand the theory. You are not able to internalize. So we appeal to each and every one of us. And as the professor mentioned, there are a lot of incursions, a lot of threats to even our area of reserve practice now. So let's put all hands on deck to ensure that we work together for the betterment of this profession within our own areas, such that at least we'll be able to leave very good legacy for the generation to come. On this note, I want to equally say that the Academy has a lot of training programs, capacity building programs, apart from the preparatory classes that we are known of. Many of them are paid programs. One of them is what our moderator has announced to us. Without wasting much of your time, all glory and adoration be to God for this opportunity. Let each and every one of us look forward to the slide in our mail and possibly the link to this the recorded video so that we can always go over and be able to grab the tips very well and apply. Honestly, with you and each and every one of us working together, we are sure that sky will be the limit of our progress. Thank you so much.
Thank you so much, sir, for the closing remark. And on this note, I want to, well, before I go, let me reemphasize something. As many people that are ready, please come and sponsor free programs for members. We are ready. We can subsidize. We can break it down, make it easy for people to do. Come and sponsor so that members can have knowledge. Thank you very much. And thank you all participants for your time, for your data. And even though we said it's free, if we don't come, there's no way we'll be able to do it. And thanks again to the facilitators and all senior members of the institution who, despite their tight schedule, they were able to come and they stayed all through. I have to mention some names here, two powerful ladies here, Esther Sovian Valua, Janet Shiu, thank you very much. Started from beginning and she's still with us. Esther Sovian Valua, Fatima Olokure, thank you so much. And thanks to our facilitators and all members of faculties of this academy that are here. And thank you and enjoy the rest of your day. Bye. Thank you, thank you, thank you. Okay.